Thanks for tuning into Talking Point. I'm your host, Niraj Shah. Our guest today is Vinay Jaising, MD and Co-Head of Portfolio Management Services at JM Financial. Vinay, great having you as always. Thanks for taking the time out. Hope all is well.
Thank you so much for the opportunity.
The pleasure is ours, Vinay. And Vinay, are the markets giving an opportunity to buy or to, as they say, just go a bit light on your portfolios because of the valuations?
So if we had this question 4-5 days ago, the market did give the opportunity, when people were concerned when the market, Nifty was going almost 10% down midday. But all that has recovered. Now, to me, it looks, do what you were doing earlier. It's business as usual. The cabinet seats are more or less, framed out to where they were earlier. You're waiting for the budget, which is the next big event a month from today. So if earlier you thought stocks were frothy in some spaces, you should change that. If you were earlier sticking to your theme of, let's say, consumption, capex, make in India, you should think to it. So you got to go now back to basics. Election is behind you. The fact is, you expected probably election going, one-sided, which is not. And, coalitions have their own set of advantages. But you still have a single standing government, which in the last 20 years would be, the third or fourth largest single standing government party votes. So I think you're just back to business, and whatever you were doing earlier, you got to stick to doing that as well.
PSUs, there was a scare that if it is not a majority, if it's a coalition government or what have you, then does the PSU theme, which has worked beautifully in the last 12 to 24 to 36 months, does it go out of the window? I would love to understand how you think about it.
So I would say, as you rightly said, 2 to 3 years ago, the discounting which PSUs had compared to the private was huge. That discounting is now narrowing down. The productivity which PSUs were working with were much lower than the private. And that productivity, debatably, is pretty much as where the private is. Then it comes to opportunities which PSU have against the private. And, case in point, let's say defense. In defense, the PSUs have a lot more capacity. They're getting a lot more orders. I guess, the Indian government is giving Indian owned companies more orders, and they've become monopolistic leaders. So you can't make a generic comment on PSUs now going ahead that as a basket would do well. But what you can say is if you can see the balance sheet and being high quality, which means no debt, good cash. If you can see an order book, which PSUs have, that's in manufacturing or in defense, then you're there. Valuations a lot more as far as PSUs are concerned. For banks, are relatively still cheaper than the private, but even the private have got derated a lot. But apart from that basket, I cannot make a generic comment now that PSUs are going to be doing as well as they've done in the last 2 years. It's all now about bottom up, picking the stocks in the PSU you like.
Okay, so then okay, let's try and focus on maybe some of the privates, right? And start off with banking. Now, and there is a larger implication to the banking conversation because in all probability, banking will do well when the foreign flow starts coming in. I would love to understand, Vinay, from you, how do you think about that piece? When will foreign money start coming back? I think it was Rhythm yesterday was making this point that if FIIs have to move away from their underweight India stance to even a marginal overweight, that leads to an inflow or that necessitates an inflow of $40 to $50 billion, which is not chop change. Love to understand when you think FIIs will come back to Indian markets.
So, I totally agree with this comment. Today, if you look at the ownership of FIIs, we haven't got the data of this quarter. Last quarter was 16.6, but we know they've already sold $4 billion in the last 1.5 months, which means FIIs have to be lower than 16% as a percentage of the overall ownership in India, and that's more than 10-year low. The average number, if I were to take 18, or if I would go to the peak level of 20, because, mind you, this is the government which has come into power for the third time, and this has happened after 1962. So, now's the time for the government to take its power and use it for whatever reforms it's produced in the past. So FIIs should see seemingly constant policy actions, and profit of India should go up. A 4% increase in FII mathematically on a $5 trillion market cap is $200 billion. So I'm assuming $200 billion divided by 4, even if they have to do it in 4 years, is $50 billion on a yearly basis, as against $25 billion last year. So it's waiting. When will it come? My bet is, come budget and you'll start seeing the same story that, CapEx numbers are great. Rural spend, which was not there earlier, maybe a little bit of a populistic bias there, would increase. But luckily, because of RBI, there's about 1.3 trillion rupees, which the Indian government can use and still stick to prudence in fiscal policy. Even oil relatively is cheaper than higher. So subsidies, are not a big picture. So as long as the budget comes where you see the fiscal prudence, you see the capex and the rural investments come in, I think FIIs will start coming in soon. Having said that, interestingly, if I were to turn your question on the other side, that why is the market high today compared to what it was, let's say, during the day the election results came out, it's been the other segment of the market. India's not just bank formation, if I may use that word, or the pension funds, the EPFO, the retail money, whether it's from UUHNIs or the rest of the Indians, that has been a strong $12 billion. I repeat, $12 billion in the last 2 months. So if you're getting flows from domestic so far, FIIs are down. As soon as they start coming in, can you imagine the liquidity the country would have? One last comment. Sorry, I'm long. We have spoken earlier about India included in debt for emerging market indices. You've already seen $15 billion of debt coming in the country in the last 12 months. Another 10 odd is expected to come in to make that number of $25 billion. So now you're seeing India flushed with inflows of forex coming into the country, which is why our forex levels are very high.
No, I mean, don't mind the long answers, Vinay. We love to listen to you, so completely fine. I was looking at the portfolios as well, and you have this very interesting terminology, finsumption. Talk to us about this.
So, India's per capita GDP, give or take, changes 2,200 to 2,500. When you go from that level to about 5,000, you start spending a lot more in consumption items, not just what you need for a day-to-day living, but you start increasing your housing, you start increasing your quality of living, you improve your quality of living. So that's the consumption angle, which comes into the picture. The second part of it is financials. Today, the banking sector loan book growth is, give or take change. I'm removing the HDFC impact of not being there last year and, Mammoth coming in this year. Between 17 to 18% is what our analyst Pooja tells us on a yearly basis. If that number even goes down to 15 to 16%, you're seeing a very robust banking system. The overall banking system price to book is low. So you will see FIIs, look at that space. My only concern in the banking system is you're seeing interest rates peak and come down. When interest rates come down, your loan book growth would be better. But that does not mean that the NIMs may not be impacted and you may see a squeeze in NIMs. And classically, when you're seeing squeeze in NIMs, even if the top line's growth, most of these companies are so efficient that they don't have much to cut on the cost part of it, that your bottom line growth, unlike the last 3 to 4 years, is not going to be north of 35%. It's actually going to be exactly like your loan book growth, which is 15 to 17%. So you're looking at the financial sector, especially banking, coming in and a growth phase of 13 to 17%, not higher than that. And that's what investors have to realize, but the valuations are very attractive. So, financials come with the consumption part of it. The consumption comes with the, as I said, the per capita GDP of the country going in. And then there are some companies in between, companies which are exchanges where retail India starts playing the financial market, and you've seen where the options market is. Because of which you start seeing the earnings growth of companies, let's say companies like BSE, grow from an EPS of, north of 20 to as much as probably 100 in the next 2 to 3 years. So you're looking at growth as much as, north of 50% per annum coming in a couple of companies, which is what investors want to see. They want to buy a country where the growth in the earnings is really good.
Yeah, most certainly. It's interesting when people compare mature developed assets to what's happening in India per se. and then talk about relative valuation. Sometimes they are right, sometimes they're wrong. Vinay, that one argument before we take a break, wherein a lot of people, like today there was a comparison, I'm just using that as an example, you may or may not have
Sure.
thoughts on that, but there was a comparison being made about how GMR Airports Infra trades at about 50 times EV/EBITDA FY24. And FY26 maybe about 25 times, that's okay. Whereas ADP, which is an owner of 32% shareholder in there, but in the global assets, they traded about 10, 15, 20 times EV/EBITDA, and how GMR might actually be expensive as per a global note from a global brokerage. Just trying to think, are these comparisons legitimate, Vinay?
It's a very interesting philosophical question. I think everything's legitimate because at the end of the day, you want to make money whether you're an Indian or whether you're putting your investments from abroad. What we as a team do is we look at valuations not just domestically, we compare them to the peers. If there is a earnings growth trajectory which is few times higher than that of their peers and the ROAS also is similar, then we would look at that company a lot more logical. I won't talk about GMR, but what I would tell you is take an example, let's say of, I'm just moving the stock into the other discussion you had on consumption. If you look at a consumption name, let's say something like a bottling plant like Varun, people globally would say this is a bottling plant. Now in India, when you look at a company and look at its earnings growth coming, top line 15 to 20%, bottom line historically grown at 30%. What you're going to say is, wow, this has definitely got a tie up with, let's say, Pepsi for the next 20 to 30 years. So though it's a bottling plant, it's actually owning the brand for a long period of time and they're partnering themselves for the future, right? When you move to the next step, then you say that the earnings growth and their ROAS are way better than that of the rest of the world. You're talking about a ROAS of, let's say, 20+%. You're talking about an earnings growth of, even today, after going up to such high levels in the EPS of 20+%, and they're an acquisition spree. So you would give a lot of other parameters, which is growth, return on capital employed, quality of balance sheet, before you come up with a conclusion that you want to buy the stock in India, if it on an absolute basis is expensive compared to the world. You mentioned obviously a company whose part ownership is global. So there will always be a holding company discount because the parent may never sell it. And if the parent doesn't sell it, let's take the case of, let's say, Grasim, will you put a discount of 30% or 50%? So once you put that number, the valuations may not be significantly different in the overall scheme of things.
Vinay, when I look at how you are building out the portfolio, if you will, so we spoke about consumption as being one of the things. I would love to understand the Make in India angle, because some people would attribute the capex cycle also to that. When you're talking about Make in India, what is your favorite, or what are the first amongst the equals?
So I would say two sectors, right? Make in India is taking care of two things. One is where globally India needs to supply products to, where it can be a replacement of China or other parts of the world, for which the manufacturing angle of India needs to be intact. And the second, more easily, is where India was doing a lot more imports and where it can replace it. On the first, you've got a couple of chemical names, you've got a couple of pharmaceutical names, which tie that basket. You've got some auto names. And in the second part of the story, you have companies like defense, which are replacing global trades, the Atmanirbhar part of what Modi ji has been pushing for the last decade, wherein you're buying a lot more domestically than the rest of the world. So both legs, capex, very important leg of it, because capex is where they're telling the Indian operators or manufacturers, we're going to buy more from you. The PLI angle, we are giving you a lot more benefits or SOPs, which they didn't give, let's say, till at least 15 to 20 years ago. They're just coming back now, giving them some benefits on the revenue share part of it. So, even the tax angle coming down from 25 to 15 for manufacturing gets this Make in India theme, either for getting the dollars for the country and supplying products which the rest of the world needs as a replacement for China, but more importantly, just not buying enough from the rest of the world and depending a lot more on the country. So both themes are very important, and capex and manufacturing are an integral part of Make in India.
Okay. Your portfolio presence seems to be around chemicals as well. It's a sector that has kind of labored along in the last 2-3 years after a fantastic previous decade. Does it make a comeback immediately, or are you still data dependent?
Extreme data dependent. So, the word chemical, I was using it a little more loosely. When we're talking about chemicals, we are adding a bit of agro, we're adding a bit of pharmaceutical, and a bit of specialty chemicals. The specialty chemicals is going to take a lot more time, I think, to catch up, because that's where you're depending on China. And China is showing some PMI data, some of their manufacturing data doing better. So that's the last leg. That's the bet you're taking on a longer period of time. But the other two legs, be it the pharmaceutical chain or be it the agro chain, that's where we think the story will emanate a lot more closer, which is in the next 3 to 6 months. That's where we would bet on a lot more today.
Okay.
We're again not changing positions significantly. We had already taken positions in them, and we're pretty happy that that this is the time we think the next 6 months they will do a lot more better than the past.
Noted. When I have one final question, can the Fed append the moves in the market by its commentary, or would you reckon it's more of status quo and watch data again?
So I'm going to break this question into two. Can the Fed do it? Yes, they have to do it because you've seen what's happened in Europe. Will they do it now? Or will they say that in the next quarter they're doing it, and they would do it, as against, if you remember, we used to earlier talk about 7 to 8 cuts. They would do it as against, let's say, 1 to 2 cuts coming in the next 3 months to 6 months. I think that's a huge possibility. They would be, why would they need to do it? Because, at the end of the day, if you look at the debt numbers of US, $34 trillion, that is a duration of somewhere close to, I think, about 6.5 years. So you're seeing about $7 trillion of debt keep on coming by for renewal. Now that $7 trillion of debt comes and you're replacing it at a higher rate of interest, as against, you cut it a couple of quarters later, a lower rate of interest. It's a circle. You're getting your own fiscal deficit higher if you were US. So they need to solve that. You've seen the pain points come up, in the credit card data, which US is giving you. You've seen the pain point come up in the mortgage data. The 2-year, 10-year chart is still negative 40 basis points with 10-year being lower. So that itself is telling you there is pain evident and they need to cut rates sooner than later. But I think because they're getting strong data points on some manufacturing part of it, they've been yo-yoing as delaying it. But it's inevitable. So you will get that news where the number of cuts will be lesser. My bet is in the next 3 months, they'll do the first cut, not today. Today, it'll be more news driven. But the second part of it, my friend, is a function of what happens to India. Because India is still, if you look at the 10-year or the 2-year chart, give or take change, if I'm not being cute, it's just 7%. It's not higher, not lower. And you're seeing so much of inflows come in the country. A big question is, are we going to decouple the interest rate fall of India with that of US? Because, if I just do, just take the two broad numbers, 7 minus 5 or 4.9, we're at 2.1, 2.2% between India and US on the longer term. That's too small, too less, as against, let's say, 4%. So I think that decoupling is getting for India being a lot more real as we start attracting, and back to your first question, more inflows, be it from FIIs or FPI.
Interesting. Vinay, thanks for breaking it down, really. Good of you to do that. And more importantly, thanks for joining us today for this long conversation. Really appreciate your time. Look forward to having more often.
Appreciate it. Thank you, team.
And viewers, thanks for tuning into this edition of The Talking Point.